All right, welcome to the Explainer. You know, getting that notice in the mail saying you owe the IRS, it can be absolutely terrifying. But what actually happens next? Today, we're going to pull back the curtain on the entire IRS collection process, step by step, so you'll know exactly what to expect and, more importantly, what you can do about it.
So let's just dive right in with the big one, maybe the scariest question of all. Can the IRS really reach in and take a piece of your Social Security check? It's a really scary thought for sure. Let's get to the bottom of it.
Okay, so the short answer? Yes, they absolutely can. The IRS calls it a levy, not a garnishment, but it's the same idea, a legal seizure. But, and this is a really big but, it's not a free-for-all. Federal law puts some very clear, very important limits on their power. See, the law is actually super specific here. The IRS can only take up to 15% of your monthly Social Security benefit. That's it. This means a full 85% of your payment is totally protected. They legally can't touch it. It's what's called a continuous levy, meaning they'll take that 15% every single month until the debt's paid, but they can't take a penny more.
Okay, so you're probably wondering, how on earth does it even get to this point? I mean, they don't just start taking your Social Security out of the blue, right? Of course not. It all starts much, much more quietly, with just one letter.
The whole thing kicks off when the IRS sends you a bill. Just a notice saying what they think you owe. And honestly, the single worst thing you can do at this stage is just ignore it. Because the second you do, penalties and interest start to build up, and it's like a tiny snowball that you just let roll downhill and get really big really fast. So what happens if you do ignore that first bill? Well, the IRS doesn't just forget about it. Nope, they kick off this very predictable automated process of sending you more letters, each one designed to get your attention.
You can almost set your watch to it. It starts out kind of tame with the CP-14, just a first notice. No response, you get reminders like the CP-501 and 503. Then you'll notice the language starts getting a lot more serious with the CP-504. That's an urgent notice. And then you get the final stop, the LT-11 or Letter 1058. That's the last formal warning before things get real.
And as these notices keep showing up and you're still not responding, the IRS starts to shift gears. They move on from just sending mail to taking actual legal steps that can seriously mess with your financial life.
The first really big move they make is filing what's called a Notice of Federal Tax Lien. This is a legal claim the government puts on all of your assets, your house, your car, everything. And because it's a public record, it's basically a giant red flag to any bank, any lender, anyone you might want to get credit from. It tells the world, hey, the government gets first dibs on this person's stuff.
All right, we've mentioned this one, but it's so important we have to focus on it. The LT-11. This is it. This is the final, official warning before they can actually start taking your property, and they have to send it by certified mail, which is their way of getting legal proof that you actually received it.
And the second that letter goes out, a clock starts ticking, a 30-day countdown. This is your last chance, your absolute final window to contact the IRS and work something out before they move from just claiming your property to actually taking it. So what if those 30 days come and go, and you still haven't done anything? Well, that's when the IRS is legally cleared to bring out the big guns, its most powerful collection tools.
Okay, so it is absolutely crucial to get the difference between these two words, lien and levy. A lien is just a legal claim. It secures the debt and it wrecks your credit, but they haven't taken anything yet. A levy? That's the actual seizure. Think of it this way. A lien is like the government putting a legal chain on your door. A levy is them breaking the door down and taking what's inside.
Yeah, a levy is the real deal. It is not a threat anymore. It's the enforcement action itself. It's the IRS actively taking your property, your money, your assets to pay off that debt.
And you might be shocked at just how far their reach goes. We're talking about everything from garnishing your wages right out of your paycheck, to freezing and clearing out your bank accounts, to even going after your retirement funds, your state tax refund, and yep, physical property, like your car, your boat, or even your home.
And get this, it's not just about your money and your property. A big enough tax debt can literally ground you. The IRS can certify your debt to the State Department, and the State Department can then say, nope, to issuing or renewing your passport. They can even revoke the one you already have.
Now, they don't do this for just a few $1,000s. This is reserved for what they call a seriously delinquent tax debt.
And for 2026, that means owing more than $66,000, a number that actually gets adjusted for inflation every year.
Now, after all of that doom and gloom, I promise there is some really good news. And this is the most important part of this whole explainer. Because even when things seem hopeless, you have powerful options. Think of them as off-ramps you can take to stop this whole collection machine in its tracks. And you'll see a theme here with all of these off-ramps. The secret sauce? It's just talking to them. Seriously, the IRS doesn't want to take your house. Their goal is just to get the debt resolved. And that's exactly why they have all these programs set up to help you out.
Okay, so the most common option by far is an installment agreement. It's pretty straightforward. As long as you're all caught up on filing your tax returns, you can usually set up a plan to make affordable monthly payments for up to 10 years. And for a lot of people, you can do the whole thing right on the IRS website without even talking to a person.
Now, what if you're in a really tough spot financially? There's something called an offer in compromise, or an OIC. This is where you might be able to legally settle your tax debt for less, sometimes a lot less, than what you actually owe. The catch is, you have to prove to the IRS that there's just no way you could ever realistically pay the full amount.
And believe it or not, there's even a pause button. If you can show them that making any payment would mean you can't afford your basic living expenses, we're talking housing, food, that kind of thing, they can put your account into what's called currently not collectible status. It doesn't make the debt disappear, but it stops all collection actions, giving you some much-needed breathing room.
So, when you boil it all down, it comes back to this one simple idea. The entire system, every letter, every warning, it's all designed to get you to just engage with them. If you ignore the problem, it is a guarantee that it will get worse. But the moment you take that first step, even just making a phone call, you open up all these pathways to a solution.
You know, just understanding how this all works can make a huge difference. It takes away the fear of the unknown, and it gives you back a sense of control. You have rights and you have options. The only thing really standing between an IRS problem and an IRS solution is taking that first step. So what's yours going to be?